Hey everyone, welcome back to Upside Down Data. In this video, I'm going to be talking about the fact that Bitcoin has not been able to hold its 20-week moving average over the past few months, and explaining why that is probably not a bearish signal. So if you like the content, subscribe to the channel, like the video, and follow us on Twitter at Upside Down Data. We put out regular updates there about our risk indicators and more. So if you've been in crypto a little while, you've probably heard people talking about how important the 20-week simple moving average is, because historically it has predicted whether a Bitcoin bull market can continue or whether an extended bear market is coming. So that's why, for example, Benjamin Cowan of Into the Cryptoverse refers to this as Bitcoin's bull market support band in combination with the 21-week exponential moving average. But recently, something odd has been happening. So if you take a look at this chart, which is Bitcoin's price history on a linear scale, with the 20-week moving average in red and the 50-week in green. Merry Christmas, by the way. Bitcoin has been seemingly unable to hold its 20-week moving average over the past few months, which is historically very bearish. Yet, at the same time, a lot of other macro, technical, and on-chain signals are bullish for Bitcoin. So for example, looking at the length of past market cycles, there's a lengthening pattern. And that suggests that Bitcoin's market cycle peak is still months or more away. On-chain, for example, we see that whales and miners are not selling their stacks in large quantities, suggesting that the smart money, quote unquote, does not think the bull market is over. So the question is, what gives? Does the 20-week just not matter anymore when it comes to predicting whether a Bitcoin bull market will continue? Is it all about the 50-week moving average now, as some people have been saying? So the answer is yes, the 20-week does not matter as much as it used to. Not only that, but it should become even less important over time when it comes to predicting whether bull markets will continue. And not only that, but the 50-week will also become less important, while moving averages of longer periods get more important, like perhaps the 100-week and then the 150, 200-week moving averages. It will be a continual process, at least to a point. So why do I say that? Well, first of all, let me give a shout out to Jay at Daily Crypto Analysis, who published a video the other day talking about the fact that Bitcoin lost the 20-week and whether or not that's a bearish sign. One thing that Jay mentioned is the possibility that the 50-week is now the critical support. Basically, that the 20-week has been replaced by the 50-week as that critical support during bull markets. His video gives a great overview of Bitcoin's relevant price history and the current price action as it relates to these moving averages. And you should definitely subscribe to his channel if you haven't already. That's Daily Crypto Analysis. But he didn't go into detail about the 50-week as new 20-week hypothesis, so I thought I'd hop on and talk about it in more detail. So basically what it comes down to, guys, is diminishing volatility. Bitcoin's volatility is diminishing. You probably know that. It's clear. It's really not up for debate. And this makes what's happening to its moving averages inevitable. So think about it like this. As the rate at which the price trends up during bull markets decreases, the percentage difference between the price and the moving average for a given period of time also decreases. So take the 20-week, for example. As the upward slope of the price during a bull market gets less steep, the current price becomes more similar to the price 20 weeks ago. This means that if the 20-week were to continue being the quote-unquote bull market support band, pullbacks during bull markets would have to get smaller and smaller in terms of percentage. And there's no evidence of that happening. I mean, the May pullback on Bitcoin's price was 56% here. The November pullback was 40% here. Those are both in line with pullbacks during previous bull markets. So if the pullbacks are about the same size in percentage terms, but the upside volatility is diminishing, which means that the slope of the bull market price trajectory is decreasing, then it has to be true that the price will find support at moving averages of increasingly high periods. Maybe now it's the 50-week, but in a few years, it could be the 100 or even 200 week. So it comes down to this. Assuming that bull market pullbacks stay roughly the same, in terms of percentage, the period of the moving average that provides bull market support should increase as an inverse function of the decrease in the slope of the price trend. To make sure that this is clear, I'm actually going to type this out. Assuming the bull market pullbacks stay roughly the same in terms of percentage, the period of the moving average that provides bull market support should increase as an inverse function of the decrease in the slope of the price trend. You can get rid of those typos for you guys. This is why. So let's put this idea to the test. If what I'm saying is true, then one implication is that the percentage above a given moving average that each market cycle peaks, so let's say the percentage above the 50-week, should decrease over time. Let's see if that's true. I'm going to do this really quickly. I'm just going to pull up these charts. So here we have this first peak in 2013. I'm not going to zoom in, just going to do it quickly, so it'll be a little bit imprecise, but about 90%. From this peak to the 50-week moving average at that point. Let's do it again. This next one, approximately 88%. Let's go to the next bull market. This peak in late 2017. This pullback here was about 80%, a little bit smaller. Let's look at this intermediate peak, even though it wasn't a new all-time high. 58%. That's smaller, but it wasn't a new all-time high. Maybe we don't read into it as much. So let's look at the more recent ones. The peak back here in the spring, at that point, 62-ish%. And most recently, this new all-time high, closer to like 32-ish%. So there is clearly a trend here for the percentage of the elevation of the price peak relative to the 50-week to be decreasing over time. So that's just really a demonstration of the logic here and why we should expect this to happen and expect it to continue happening. So what's the moral of the story? I think the moral is to think critically about the metrics and indicators you're using. Don't just rely on heuristics that have worked in the past. Bitcoin is young, it's evolving quickly, and some of the numbers that are important now are not going to stay important forever. So don't be deterministic when you see something happen on the chart and that, in the past led things in a bullish or bearish direction, because these things always happen in context. And if you're not paying attention to the context and how it's changing, but just mindlessly playing an if-then game with specific triggers, then sooner or later, you're gonna get it very wrong. So that's all for now. Hope this was useful. Thanks for watching.